Hey traders, Gavin McMaster here from Options Trading IQ, and today we're going to take a look at a earnings trade idea on PLTR. Just before we do, a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. All right, so let's jump in and take a look at PLTR. What we're looking at here is a cash secured put trade, and it's for the first expiration after earnings. So we're selling the first strike out of the money. We're going to get $154 per contract for selling that spread or that option. And what we're looking at here is just the huge implied volatility because of that earnings announcement. We can see the implied vol on the stock is 74%, but the implied vol on this particular put option is up at 118%. So we're really using the uncertainty around earnings to our advantage to generate a huge amount of premium. Now, obviously, the risk is that the stock might have a big drop and we're going to end up in a loss situation if the stock drops below about 20.50. But that's a risk I'm willing to take in this case. And what I'll do, if the stock goes below 22, we get assigned, we take ownership of the shares, I'll sell covered calls against that position and just continue selling those calls up at around $22, $23 strike price until the shares eventually get called away. If it stays above 22, it expires worthless, we keep the premium and we're good to go. We can move on to the next stock. So I always like to plug the numbers into my little calculator here. It's an Excel calculator. If you don't have a copy of this, just reach out to me. But basically, we just need to fill in these cells in green. So the expiration dates, yeah, that's better. Stock price, $22.37. And the premium, let's say we get $1.50 for it. So we can see we've got a 8% margin for error on the downside and a potential almost 300% annualized return because we're generating a large amount of premium relative to the stock price in a short space of time. So it's a high risk trade because of earnings, and you don't achieve returns like this without having to accept some form of risk. So the risk, as you can see, it's a highly volatile stock. It could easily drop 10, 20% on earnings. So that is the risk that we're facing. Now, I want to compare that with a slightly longer term trade where if rather than choosing the first expiration after earnings, we were going to choose the June monthly expiration. The reason why I wouldn't choose this particular expiration, yes, we're generating a bit more premium, but we're only generating an extra $45 in premium, and we're having to wait an extra 6 or 7 weeks to get that extra $45. So it's not really worth it. And you can see here, the implied volatility isn't as high. So it's always the first expiration after earnings that has the biggest impact with that implied volatility. So we're getting the best bang for our buck with this short-term option. And I just wanted to show you why I wouldn't choose this particular one and I would go with this one. So one other risk with the trade is we've got some sell ratings by various analysts. So that's a little bit of a concern there as well. And it is a highly volatile stock. So just keep that in mind. And if we go over to Market Chameleon, we can get a look at what the stock has done over the past few earnings announcements. It's definitely had a couple of times when it's dropped 15, 20%. So a little bit of concern there. The last few have been relatively good or very good, in fact. So we'll see. Provided the stock doesn't drop by too much, we'll be okay. If it does drop, we'll take ownership. We'll self-cover calls against it until those shares get called away. Best of luck with your trading. Have a great day.